Hello traders, and welcome to the Technical Trade Room. My name is Joseph, and in today's educational video, we're going to cover the candlestick charting technique, how to read candlesticks and explain 20 different candlestick patterns. As always, I've got to start with a quick disclaimer. Statements by TTR or its members are opinions and not investment advice. TTR is not responsible for any investment decisions made using the information provided. Improvements are not guaranteed. This material does not take into account your particular investment objectives, financial situation, or needs and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on TTR. Whew, that is a mouthful. Well, with that out of the way, let's get down to business. Let's start with a quick overview of the candlestick charting technique. Candlestick charting is thought to have had its origins in 17th century Japan. Although a contested fact, a rice merchant by the name of Munehisa Homa is credited with creating what would be the beginnings of the candlestick technique after noticing a futures market in rice forming. In 1991, Steve Neeson released the book Japanese Candlestick Charting Techniques, and the candlestick charting technique was introduced into the American stock market. Candlesticks are a great visual aid to help see price movement within a given time period without getting inundated with data. However, it will not help you see into the future or predict market activity with absolute certainty. It should be used with other technical analysis techniques. And finally, candlesticks are the chart type of choice for TTR. I also think it's pertinent to give a quick review of simple supply and demand theory and how that will affect a stock price movement. Now, if a stock has negative movement, it's generally because there are more sellers than buyers present in the stock. When this happens, the buyers have the leverage to ask for a lower price, and this causes the price of the stock to go down. Okay, so now, if a stock has positive price movement, it's generally because there are more buyers than sellers present. And when this happens, the sellers have the leverage to ask for a higher price, and this causes the price of the stock to go up. Now that we understand what the colors of candlesticks mean, and have reviewed why prices generally move, let's cover how to read an actual candlestick. First, let's start with a green candlestick. The bottom of the rectangle is where the stock's price opens, and the top of the rectangle is where the stock's price closes. As we can see from the example, the close is higher than the open, showing positive movement. Now, the lines above and below the rectangle are what we call wicks. The line on the top shows the highest point the stock price reached during that time frame, and the bottom line shows the lowest point the stock price reached during that time frame. The white candlestick from the black and white color scheme also works the same exact way. Okay, now let's go over how to read a red candlestick. At the top of the rectangle is where the stock's price opened. At the bottom of the rectangle is where the stock's price closed. As we can see from the example, the close is lower than the open, showing negative movement. Again, the lines above and below the rectangle are what we call wicks. The line on the top shows the highest point of the stock's price during that time frame, and the bottom line shows the lowest point of the stock's price during that time frame. The black candlestick from the black and white color scheme works the same exact way. Okay, so there are three parts to each candlestick. First, the real body, which is the rectangle of the candlestick or the open and close points of the stock. Second, we have the upper shadow, which shows how high the price went after it opened but before it closed. And third, the lower shadow, which shows how low the price went after it opened but before it closed. That might be a lot to take in with still pictures, so let's review that one more time, but with a moving example of each. Each example will cover a simulated 3-minute span. First, let's start with a green candle. Where the candle starts is always considered its open. In the first minute of trading, the stock has gone down in price slightly. In the second minute, buyers increase and the stock price shoots up. Note that a wick has now appeared where the price was at its lowest. And finally, in the third minute, the stock goes down slightly, revealing our top wick and forming the final formation for our 3-minute time frame. Now, let's do a red candle. Where the candle opens is always considered its open. In the first minute of trading, the stock goes up in price slightly. In the second minute, sellers increase and the stock price drops down. Note that a wick has now appeared where the price was at its highest. Finally, in the third minute, the stock goes up slightly, revealing our bottom wick and forming the final formation for our 3-minute time frame. As in our previous example, the real body is the rectangles of the candlesticks, or the open and closes of the stock's price. The upper shadow shows how high the price went, and the lower shadow shows how low the price went. Now that we've gone over how to read a candlestick, let's review 4 common shapes that you'll encounter while reading candlestick charts and what they mean to you. First, we have the doji candlestick, which stands for market indecision and translates into mistake from Japanese. A doji candlestick appears when a stock's closing price is close to or exact to its opening price. A doji has no rectangle or real body, but the stock may have moved within the time frame, and if it did, that movement can be seen in its wicks. The doji is considered a neutral candlestick. Second, we have the spinning top. A spinning top resembles exactly what it is named after. There will be equally sized wicks, both top and bottom, with a smaller real body. Spinning tops are candlesticks of indecision, as both buyers and sellers moved the stock's price within the time frame, but one group was able to pull out a victory and allowed the stock to move a little in that direction. Third, we have the marubozu, which translates into a shaved head or bald head from Japanese. Very important and very easy to spot, this candlestick is the exact opposite of the doji, as it represents decisive movement. It is entirely made of a real body and has no shadows or wicks. From start to finish, this candlestick moved in one direction and never looked back. Fourth is the star candlestick. Stars are smaller candlesticks that have jumped a fair distance from their previous candle, usually made of a small body and shadows or wicks, either above or below the previous candle. Stars represent consolidation. If a star appears, a stock moved a fair distance in a short period of time and may be heading towards a reversal. Alright, now that we've covered a fair amount of the basics, let's go over some bullish candlestick patterns. Before we start, I'm going to do a quick overview of how we'll cover each candlestick pattern. On the right side of the screen, we'll have examples of candlestick charts. And as currently shown, the specific candle we'd like to pay attention to will have a yellow arrow pointing to it. On the left side of the screen, we'll give an example of the candlestick in question, and here, we're now looking at what we call a hammer candlestick. Each example will show where the candle opened, which is the bottom of the real body for positive candles. Then we'll show where the candle closed, which will be the top of the real body. We'll then show the highest point, or the upper shadow of the candle, and we'll finish by showing the lowest point, or the lower shadow of that candle. With that out of the way, you want to try to find a hammer after a downtrend. The candle opens and continues the previous downtrend at first. But buyers rally, think the stock has gone down far enough, and the negative momentum is squashed to create a positive candle. This is considered a reversal. So, a positive trend may be seen after this. Next we'll cover inverted hammers. They are strongest after a downtrend. The candle opens and reverses the previous downtrend by shooting upwards. But indecision creeps in, buyers pull back, and a much smaller positive gain is achieved by the end of the time frame. This is a potential reversal point, and a positive view of the inverted hammer would say that the candle has created a preview of what is yet to come. So a positive trend may be seen after this. Third is the dragonfly doji. Now, dragonfly dojis are rare, but they're strongest during an extended downtrend. Similar to the hammer, the dragonfly doji opens and continues the previous downtrend at first, but it reverses and closes right back to its opening price. In my experiences, this is a potential reversal, so a positive trend may be seen after this. Next, we'll cover a common candlestick, the bullish spinning top. Spinning tops, as previously explained, are candles of indecision, as once the stock opens, the price goes down, then up, then back down, with either the buyers or sellers squeaking out a victory by moving the candle slightly in their favor. This is not considered a reversal, and it is common in sideways movement. This candle can also represent market disinterest if there is a small real body with matching small shadows. The bullish engulfing is an important candle to note. As with most of our examples here, it is most effective after a downtrend. The bullish engulfing opens below the lowest point of the previous candle and surges upward and closes above the highest point of the previous candle. The distinguishable trait of the bullish engulfing is that the real body of the candle completely engulfs the previous candle, as shown in the example on the screen. This is definitely a reversal candle, so a positive trend may be seen after this. The morning star is a sign of good things to come, and is strongest after a downtrend. The current candle opens a fair distance below the previous candle, recovers slightly in a show of consolidation, and is immediately followed by a positive candle. This is a reversal sign, so a positive trend may be seen after this. Similar to the morning star, the bullish abandoned baby is strongest after a downtrend. The current candle opens a large distance below the previous candle, and it closes with a small gain far below the previous candle. This is a sign of reversal, as the stock has consolidated because the market thinks the price has decreased far too much, but buyers are currently silent. Once the buyers start opening their positions, the stock sees an immediate jump up into a positive candle that is slightly higher or equal to the previous negative candle. This is what we call the parents of the abandoned baby. A positive trend may be seen after this. Harami, which translates into pregnant in Japanese, is a candlestick of possibilities. Best after a continued downtrend, the harami opens and then closes, creating a small candle. The reason we call it a harami is that the entire candle is within the real body of the previous candle. This is a sign of consolidation, as the previous candle's movement has been calmed, and a bullish harami looks to create a positive trend in the future. The three white soldiers is a strong sign of a bullish trend. Best after an extended downtrend. A candle of consolidation will appear, killing the negative trend from before. This is then followed by a significant gain, also known as the first white soldier, which is the confirmed reversal of that previous negative trend. The first soldier has backup, as a second significant gain is right after it, with a third right after the second. A continued positive trend may be seen after this. Our 10th and final bullish pattern is the piercing line, which is an interesting and effective reversal sign. As with all of our examples, strongest after a downtrend, the piercing line opens below the previous candle, and it recovers back into the real body of that previous candle, closing around the halfway point of the previous candle's real body. If the candle closes below the halfway point, this is not called a piercing line. If it closes below the halfway point, we call this an in-neck candle. If it closes around the opening of the previous candle, we call this an on-neck candle. If we find a piercing line, this is a reversal sign, and a positive trend may be seen after this. Now that we've covered 10 bullish patterns, let's cover 10 bearish candlestick patterns. The hanging man will be the first bearish candle that we cover. Most effective after a positive trend, it is the opposing candle to the hammer. This candle opens up and the previous positive trend is erased as the stock plummets. However, what gives the hanging man its characteristic long wick is that the stock recovers after creating that low and closes at a much smaller loss. This is a reversal sign, and the wick may be a preview of what's to come, so a negative trend may be seen after this. The shooting star is the opposing candle to the inverted hammer. The shooting star is best after a prolonged positive trend. The candle opens up, continuing the momentum from before, from the positive trend, shooting up into the sky and creating an ambitious high. However, the high is a little too ambitious as the market agrees the price has gone far too high, and profit takers begin to leave the stock. This is an effective reversal sign as it triggers buyers to start taking their profits. So, a negative trend may be seen after this. Gravestone dojis are rare, like their counterpart, the dragonfly, and are strongest during an uptrend. Similar to the shooting star, the gravestone doji will open and continue the previous uptrend at first. However, it reverses and closes right back at its opening price. In my experiences, this is a potential reversal, so a negative trend may be seen after this. Next, we'll cover another common candlestick that you'll encounter all the time, the bearish spinning top. Spinning tops, as previously stated before, are candlesticks of indecision, as once the stock price opens, the price goes up, then down, then back up, with either the buyers or sellers squeaking out a victory by moving the candle slightly in their favor. This is not considered a reversal, and is common in sideways movement. This candle can also represent market disinterest if there is a small real body with matching small shadows. The bearish engulfing is another important candle to note. The opposing candle to the bullish engulfing, it is most effective after an uptrend. The bearish engulfing opens above its highest point of the previous candle. It surges downward and closes below the lowest point of the previous candle. The distinguishable trait of the bearish engulfing is that the real body of the candle completely engulfs the previous candle, as shown in the example on the screen. This is a reversal candle, so a negative trend may be seen after this. The opposing candle to the morning star, the evening star, is a sign of bad things to come, and is strongest after an uptrend. The current candle opens a fair distance above the previous candle. It then dips slightly in a show of consolidation and is then immediately followed by a negative candle. This is a reversal, as the market may think the price is too high and profit takers begin to close their positions. Because of this, a negative trend may be seen after. Similar to the evening star, the bearish abandoned baby is strongest after an uptrend. The current candle opens a large distance above the previous candle, but then closes as a small negative candle high above that previous candle. This is a sign of reversal, as the stock has consolidated because the market thinks the price has increased far too much, but profit takers are currently absent. Once those profit takers begin to close their positions, the stock sees an immediate fall back down to a negative candle that is slightly higher or equal to the previous positive candle. This creates what we call the parents of the abandoned baby, and a negative trend may be seen after it. Best after a continued uptrend, the bearish harami opens and then closes, creating a small candle. As stated before, the reason we call it a harami is that the entire candle is within the real body of the previous candle. This, again, is a sign of consolidation, as the previous candle's momentum has been reversed, and a bearish harami looks to create a negative trend in the future. The three black crows, which is the opposite of the three white soldiers, is a strong display of a bearish trend. It is strongest after an extended uptrend. A candle of consolidation appears, killing the positive trend from before. This is then followed by a significant loss, which is the first black crow, the confirmed reversal of the previous trend. Now, crows fly in a group known as a murder, which is true here, as a second significant loss murders the previous upward trend, and a third significant loss follows the second. A continued negative trend may be seen after this. The dark cloud cover is a sister to the bearish engulfing and cousin to the piercing line. It is another potent reversal sign. Best after an upward trend, the dark cloud cover opens above the previous candle. It then reverts into the real body of the previous candle, closing at around the halfway point of the previous candle's real body. Think of this, if you will, like clouds covering the sun. The deeper the candle closes into the previous candle's real body, the more severe the pullback, and thus the more light blocked out by the clouds. This is a reversal sign, and a negative trend may be seen after it. Okay, I know that was a lot to take in, but let's review what we covered in today's lesson. We covered a short history of the candlestick charting technique and noted that reading candlesticks will not allow you to predict the future of the market with absolute certainty. We use candlesticks in conjunction with other technical analysis techniques in helping us make educated financial decisions. We also covered the 3 parts to each candlestick. First, the real body, which is the opening and closing of the stock price in that time frame. Second, the upper shadow, which represents the highest point of the candle in that time frame. And third, the lower shadow, which represents the lowest point of the candle in that time frame. Finally, we discussed the 3 different types of candlesticks you'll encounter. Bullish candles, or positive movement, which included the hammer, inverted hammer, bullish engulfing, morning star, and 3 white soldiers. We also covered some bearish candlesticks as well, or negative movement, which included the hangman, shooting star, bearish engulfing, evening star, and 3 black crows. We also covered the doji, which is a neutral candle. I hope this video has been helpful to you, and I'd now like to extend an invitation for you to come join the Technical Trade Room. If you've made the decision to start trading, or you're looking for a great community to be a part of, please feel free to join our outstanding equity trading community on Discord. We offer the following for free to all of our members: daily stock market conversations, real-time voice chatting, daily and weekly watch list, access to knowledgeable traders, free thinkorswim studies and scanners, and more educational videos just like this one. Thank you so much for watching, everyone. Please like this video and subscribe to our channel to get future content from TTR. We wish you good trading and hope to trade better together with you. This is Joseph from TTR, signing off.